Good morning, real estate mindset community, and welcome to this morning's live video. Today, we're going to talk about what the Federal Reserve plans on doing next. Are the rate hikes coming to an end finally, or will there be additional rate hikes? And the biggest question is are the rate hikes enough to bring balance back to our housing market? Now, obviously, guys, there's an awful lot of lagging going on and also excess savings that had to be spent. But now that we're going into the fall and winter months and we have a lot more economic headwinds, I suspect that we're going to be seeing a Federal Reserve again that does change their policies. And where I'm going to start, guys, is by jumping into a Wall Street Journal article from Nick T, which is basically the Federal Reserve's mouthpiece. And then after that, we'll go over the housing market update. We'll look at the CME Fed Watch. We'll look at amortization schedules. And we're going to look at a few videos that talk about the recession. You know, a lot of people are saying the recession got postponed. It's going to be next year now. And then we'll listen to a video about the concerns with job loss right now. A lot of people are starting to get extremely concerned with the trajectory of unemployment right now and with the downward revisions. There has been so many revisions. Now, the third video is going to be of Danielle DiMartino Booth. Okay, we've been listening to her a little bit, and I thought the video was actually really surprising, guys, because she is acting concerned. She kind of sees concern. She does not believe that the Federal Reserve should continue to hike interest rates. So it's going to be some good stuff for you guys today. Don't forget to like the video. I just wanted to say good morning to everyone. I see you guys. I see everyone. Vovo, everyone. I see you guys. Absolutely love you. And again, real quick, guys, thank you for joining our live. Hopefully you guys are getting some wisdom here and you're understanding what's going on in the housing market. A lot of stuff going on. But again, let's start here, guys. The Wall Street Journal. And again, this is Nick T. Okay. If you guys don't know who Nick T is generally that's who the Federal Reserve releases information to, like Nick T. So this guy's pretty credible. What he says is pretty credible. Now, I'm not going to read this entire article, guys. I'm just going to highlight some important things, which is basically the difference of opinion of the Federal Reserve voting members. Some people think that we shouldn't raise rates. Some people think that we should raise rates. But one thing's for sure, it's coming to an end, as long as there's not runaway inflation like we have in the housing market right now. Now, an important shift in Fed officials' rate stance is underway. Central bank is likely to pause rate increases in September, then take a harder look on whether more are needed. So they're starting to see cracks, you guys. They are starting to see cracks. We will see that as consumers as well. But as consumers, usually we see that last, except if you've been watching my channel. Hopefully we are like months ahead of the curve on this one. Now, this goes on. Some officials still prefer to err on the side of raising rates too much, reasoning that they can just cut them later. Now, though, other officials see risk as more balanced. They worry about raising rates and causing a downturn that turns out to be unnecessary or triggering a new bout of financial turmoil. Well, we already have that in the housing market, wouldn't you say? At least consumers, the little people, already have financial turmoil. The little people, well, like I was going to say like us, you guys may not be little, I'm little. The shift towards a more balanced bias on rates is driven by data showing easing inflation and less overheated labor market conditions. In addition, the unusually rapid rate increases implemented over the past year and a half are expected to continue crimping demand in coming months. So goes into the lag effect, right? And Jerome Powell has said this numerous times. You know, the economy has yet to feel the full strength of the interest rates, Geez, the lag, you guys think that the lag, do you think the bailout this year helped with that lag? I'm gonna, if I were a betting man, I would bet a lot of money to say that bailout in March changed everything. Everything was changed because of that March bailout. Now, the bigger debate is what would prompt them to raise rates again in November or December. Because remember, guys, in June, most officials projected they would need to raise rates by another quarter point this year, making it 2 rate hikes. They've already done 1. So they said a second one would be needed. But again, that was back middle of this year. Now we have more data. Now, projections to be released at the end of September meeting will likely show that an additional increase is still on the table. But whether they deliver such an increase is an open question because they don't want people to think that they're done tightening and that they're done raising rates. If they do that, inflation will probably become unhinged again. This is apparent from how Fed Chair Jerome Powell recently described, listen, the risk that firmer than expected economic activity would slow recent progress on inflation. Housing market, get it? Okay, last month he twice used the word could instead of a more muscular word would to describe whether the Fed would tighten again. Evidence of stronger growth, and this is him talking about the housing market. Okay, this is his quote about the housing market, like the one couple, paragraph he even talked about the housing market, and it's been like 6 months. So thank goodness he mentioned some of it. But this is what he said, in case you guys don't remember. The housing market could put further progress at risk and could warrant further tightening of monetary policy. Okay, now here's the other camp of officials. So one camp is like, I don't know if we should raise rates. We could trigger recession and financial turmoil. Okay, so the other camp is saying this. One camp of officials is still anxious about inflation, probably the shelter inflation, right? Is still anxious about inflation and wants an insurance policy against it by raising rates again this fall. I like this group of people. I like. These policymakers worry about ending their tightening campaign only to discover in coming months that it didn't go far enough. It could be particularly disruptive if financial markets are led to believe inflation and interest rates have flattened out, only to learn the opposite. And remember, that's what we started to see, this dead cat bounce or rebound in the housing market. You guys, it's literally, I mean, I don't know how else to describe it, but like it was runaway inflation. That runaway inflation messed up their goals of fighting inflation, according to them, right? I mean, the whole time, we've been wanting 8 and 9% interest rates from the beginning. We've been wanting the 10-year treasury to be above 4% since the beginning. When we look back at the trajectory of the trends and what happened, a lot of it, I mean, it all boils down to the Federal Reserve. The start of this, the end of this, the middle, it's all the Federal Reserve. We need to continue to keep our eyes on what they're doing. Over tightening is a risk, okay? Over tightening is a risk, but we've been underestimating inflation. Thank you, Cleveland federal president. Thank you, because that's exactly right. They have been underestimating inflation. Allowing inflation to be up for longer does carry a cost for the economy. And who's paying that cost, you guys? I mean, comment below. Let me know if you think that the Federal Reserve has done enough to basically fight inflation. Some people think that they have, some people think that they haven't. I can tell you, I don't believe they have, specifically pertaining to shelter inflation, the housing market run up. And I know there's been disinflation. Not really. Actually, there hasn't really been disinflation, but we want deflation. We want the prices to go down. I mean, look at the PE ratios, the price to earning ratios. Everything is completely out of control. We're going to move on, guys, to our housing market and overall market update right now. We're going to start by taking a look at the 10-year treasury. I always like to start here, and then we'll follow that 10-year treasury around as we go on through this video. Now, the 10-year treasury is basically flatlined, okay? It's not really up or down right now. It's kind of trying to figure out what to do. It actually started the morning down, then it went up a little bit, and then it went down, and then it's up slightly. But right now, you guys, I think what's going to happen is we're not going to see a lot of movement until after the Federal Reserve meets and tells us what's going on, okay? But this is what's going on with the 10-year treasury. Let me show you the impact on residential mortgage rates now. So we finally are getting like you remember yesterday when I did the live yesterday, I was like, the rates only went up 1 or 2, I think it was 2 basis points. And I was like, that's not adding in the total increase of the 10-year. We finally saw that hit the interest rates yesterday. So interest rates right now, you guys, are a whopping 7.3%. A lot of people think they're going to hit 8%. If the 10-year treasury, the thing that we just looked at right here, if this hits 5%, some people are saying it's going to hit 5%. Okay. I want it to hit 5%. I don't think it's going to. I don't think that the economy can handle it, specifically corporate world. I don't think they can handle it. But if that hits 5%, I could almost guarantee you we will have interest rates mid 8%, maybe low 8%. But right now we're sitting at 7.3%. Let me show you guys how much interest you're going to pay at 7.3%. Just to remind you guys, a lot of people are running out to buy right now. Do you, whatever, right? But I wanted to show you how much interest people are actually going to pay at a $410,000 house price with an 18% down payment, which is the average down payment, you guys. Now, here's the range on what you would be paying in just 5 years, okay? You're going to be paying $120 on an average house with an 18% down payment. So if you don't have a down payment or it's a minimum down payment, add a lot to this. But with the 18% down payment, you're going to pay $120 to $125,000 in fees the first 5 years of that loan. Pretty shocking. And if we really break it down by looking at the amortization schedule, you guys are probably familiar with this. I put in the 7.3% interest rate right here. You guys can see the total amount of interest on a loan amount of $336,000 is nearly $500,000. And remember the trick I've been trying to teach you guys. If you take money after you close and you put that money down on your principal, you save a substantial amount of time and even like crazy amount of money. And remember, the reason that is especially the first 5 years of a mortgage are devastating from a fee and interest aspect because amortization schedules are front loaded with interest. But I did want to just point out one more time, if you guys close and then you pay $20,000, about $20,000 down, you guys would save over 5 years. And you would save in all of these tiers of interest. You guys see these first 5 tiers of interest, that would total roughly close, a little less, but about $120,000 in interest savings over 25 years. Now, obviously, you might not want to do that if your plan is to refinance. And I always tell you guys, don't buy a house assuming you can refinance in the future. Now, let's take a look at the CME FedWatch tool right here, guys. This is what the market is anticipating. Let's start with September. So really no change in September. Pretty much unanimous, guys. There's probably not going to be a rate hike in September. But what do we get tomorrow? We get all kinds of stuff tomorrow. We get all kinds of stuff this week. And remember, you guys, they're going to be meeting on Wednesday of next week to decide whether or not to hike rates. But again, that's probably not going to happen. But let me show you guys what's interesting. For the first time, December and November have flipped. Because remember, the market was anticipating a stronger likelihood of a quarter BIP hike in November over December, but look, it has shifted. It's saying 42% likelihood of the second rate hike in November, but look at December. Okay, so this dropped a little bit, 42.5. So again, for the first time since I've been following this, I'm now seeing the market price in a higher likelihood of the second rate hike in September. That's very interesting to me, but take a look at this. This is the good news, guys. When we look at January, okay, January, when I add all of this stuff up, and remember, here's where we're sitting right now. If anything happens to the rates, this will all change. But if we look at this numbers, okay, if we look at the market's saying in January, because that's when they'll meet next, right? Well, after September, November, December, and then the next meeting after that's January, there's a 92% likelihood that we will have rates where they're at right now or higher. So 92% likelihood, that is good because we do not want them to cut rates too soon, okay? Now, also beautiful, okay? This is really good. In March, 76% chance that rates stay elevated or where they're at right now, okay? Or where they're at right now or higher. 76% chance. That is a beautiful thing because we don't want rates to be cut right before home buying season starts like what happened this year. Even though they didn't even technically cut the rates dropped, almost a full percentage point in the front of spring home buying season. That was awful. Let's look at May, you guys. May, still pretty good. All right. This is what you want to see. Okay. May, 56% likelihood. So it's more likely than not that we will have interest rates where they're at right now or higher according to the market in May. That's good, guys, but it gets worse when we go to June. Excuse me. So June is saying 35% chance only. So they're saying probably the first cut, the market's saying probably the first cut, barring any, black swans or, unforeseen economic turmoil, 35% chance to stay elevated. Now, when we get to July, it tanks hard in July, only 18% chance in July. So not a huge chance in July. Now, I wanted to show you guys something that's interesting. We've been watching the outflow of money, Okay, there's been an awful lot of money printing, excess savings, M2, all of this type of stuff. We've been watching a lot something called the overnight reverse repo market, which is where lenders, banks, depository institutions plant their money. It's like a one-day treasury, and it's been going down pretty significantly. Now, it has been going down because the market has anticipated that the Fed is done hiking rates. However, take a look at this, guys. It actually has gone up. See that right there? So day over day, and it's very slight, but it went up day over day. That's not a trend. I'm not saying it's a trend, but it is possible that the market, once again, is waiting out until that second rate hike. If there's another rate hike and then the Fed says we're done, we're probably going to see money flood out of here into long-term yields, out of these short-term yields. You guys know what I'm talking about? Does that make sense? All right, so that's the reverse repo market. What we're going to do now, guys, is we're going to go into our first video that's basically going to go into the fact that basically their suits are expecting now the recession to be next year. They're going to go in this video basically how some information is good on the economy as far as fighting inflation, and some information is bad. But either way, they're, almost everyone is now pushing the recession to next year. Again, I think it has a lot to do with the $400 billion, not $400. I wish it was $400, $400 billion bailout. But let's look at our first video. And if you guys don't mind, please tell me that my audio is okay. And I hope you enjoy.
Citi's global chief economist Nathan Sheets is with us. Nathan, great to see you again. Has your view been incrementally altered, at least by the data this week?
Well, I can tell you that we continue to expect a recession, most likely during the first half of next year, but we're not seeing any evidence yet of it in these data. I think on the one hand, you have a gradually moderating, and I would even say slowing, but a gradually moderating economy. And on the other hand, we're seeing gradual evidence of ongoing disinflation. And frankly, when I look at these data, what would a soft landing look like? And I think they'd look very much like what we're seeing. And the main reason that we continue to expect that recession is really based on history, that when the economy's been this hot and the unemployment rate has been this low, that the unwinding of that at some point in the process entails a recession. But, that's a pretty lonely call when I look at some of these kind of Goldilocks, for lack of a better term, these Goldilocks data.
So which would be a bigger mistake, Nathan, for the Fed to stop hiking now with core PCE still more than double the target, or for them to keep hiking as we've seen a continued step down in the monthly rate of inflation increases?
I think at this stage that the Fed has hiked significantly. Monetary policy by most metrics is restrictive. And I think what the Fed needs to do is maintain the type policy that it has and let the data come to them. And if over time they see that inflation is proving to be more stubborn than they expect, then they can hike a bit more. On the other hand, it may be that medicine that they've administered proves sufficient. And maybe they won't need to hike, maybe another 25, but not much more from where they are. But I think they can be empirical. I think they can be incremental. And I think they can be gradual at this stage. And frankly, for me, that was the major takeaway from Jay Powell's Jackson Hole speech last week.
Nathan, big number tomorrow. And what's your view for non-farm payrolls? And are you of the belief that you can start to see real disinflation, deflation without unemployment rocketing higher?
Well, on the second part of your question, historically that hasn't been the case. And our forecast certainly doesn't include that. But we have seen core PCE come down over the last 18 months. We've seen some moderation in wage growth, even as the unemployment rate has remained very low. And I think this is happening against the backdrop of a what should I say, a gradually moderating, again, I come to that word, gradually moderating labor market, where job gains, they're still solid. I think consensus is around 170 for tomorrow's number. Seems reasonable. We're expecting something a little lower because of the screenwriters strike, which could take a little bit off it. But a gradually moderating labor market, and if that moderation continues, then maybe we will be able to get out of this without a recession. But
All right, guys. So let me know what your thoughts are. Let me know if you guys think that we're going to be able to get out of this without recession. I think it's interesting. If we look back at the history, we've never not been able to prevent recession when inflation has been over 5%. Never in the history. In fact, when going back to history, there's only 2 times where I have found that the Federal Reserve got us to a soft landing. One was in 1965 and one was in 1984, and none of the time inflation was this high. So I think people are delusional. I think people are delusional. I think people are buying into the narrative that things are okay, when the reality is, guys, is things, in my opinion at least, are not okay. Let me throw some comments up right here, and then we'll get into our second video. Some really good consumer questions right here. Travis, you say do a market analysis to determine a good deal, but unless you're a real estate agent, an average citizen does not have access to the MLS, or multiple listing service. Is it possible doing a market analysis with sites like Zillow? The thing is, Rob, that the premise of the entire premise of the market analysis is using data that has already been sold. One of the problems with Zillow and Redfin is they don't give you that comparable or comp, right? A comp is a sold property. So they don't give you the comp information on those websites. So unfortunately, Rob, and I say this all the time, use a market analysis to interview realtors, because again, they have access to the MLS. If it's me, I'm calling realtors, I'm being honest with them about my scenario, and I'm going to ask them to provide a market analysis for both the rent and the price per square foot in the subdivision of the property. Again, the subdivision of the property that I'm interested in. But Rob, that is a frustrating thing. So either that or get your license, brother. I think we should all get our license, to be honest with you. Here's a question, you guys. If you a comment, if you shop and only stay with a 15-year mortgage, there's so much money saved. Lenders don't want you to focus on payment amount. They want you to focus on the payment amount and not the cost of the loan. And he's absolutely right, you guys. The hugest benefit of the 15-year mortgage is it saves you so much in interest. The problem with the 15 years right now, guys, is the payment is astronomical. So you're locked into a higher payment, when if you did like bi-weekly or paid extra money to principal, you could still turn a 30-year loan into a 15-year loan by playing the amortization schedule game. Here's a question or comment from J and G Miller. Every day that passes, less and less people credit score can get a home loan. Personal debt will collapse the market as a whole. And he's right. Not only do we have credit tightening, consumer health right now is deteriorating rapidly. Again, when we look at month over month unemployment, 30 basis points, when we annualize that, unemployment can get to 6% in 1 year from now if it's annualized that way. Plus, what else do we have? School loans have already started, but the payments start next month. Credit card debt has exploded. Car debt has exploded. And the important thing to understand about the consumer is they also can't save money. They're anticipating next month they're going to be out of excess savings, and the default rate for credit cards and for auto loans is skyrocketing and above pre-pandemic. So in other words, guys, we got to make sure that we can stay ahead of problems, that we can stay ahead of economic uncertainty, stay ahead of turmoil. And how do you do that? You got it. The way you do that, comprehension of your local market and purchasing power. Increase your purchasing power, your credit, your income, your assets. Here's a comment from House Hacker. Now, House Hacker was able to purchase a home in San Diego. House Hacker, I think it was mid last year. It could have been at the end of 2022, but I think it was House Hacker bought, and San Diego's hard. The reason I'm respecting him so much is understand San Diego, California has like literally no inventory, but the unaffordability is almost like historical. It actually is historical, but it's almost the worst in the nation. So he's basically suggesting that if people are buying right now, especially the first-time home buyers, you're looking for a deal, he's saying you want to look between October and January. I say December to February. So we're basically right there, because generally, guys, those are when price cuts are the strongest in the housing market. Here's a comment right here. Okay, and then this one has to go into what I was saying. If you take a 15-year mortgage, you're locked into the higher payment. But on a 30-year mortgage, you guys can make extra payments to turn it into a 15-year loan and not be locked into a higher interest rate. So some super good comments, guys. I'm going to move on to our next video right now, which is going to go into, let's see here, jobs. Here we go right here. I was going to pull up the 2 and the 10, but I'll do that here in a minute. So this is very interesting, actually. Tell me what you guys think about this. Comment below and let me know what you think.
Show you this relationship between gas prices and inflation, at least the 1-year inflation expectations. They run together pretty solidly. When the gas prices go up, people's inflation expectations rise. But look at the end there. The blue and the red lines are kind of apart for now. A lot of the run up in and oil prices happen at the end of the month. We'll see if there's catch up. And with the CPI coming, guys, it's something to watch here. One of the concerns of the Fed is inflation expectations and the extent to which it's embedded in there. That chart shows we're a percentage point higher than we were before the pandemic. And the Fed, I'm pretty sure, will not want 3.5%, 3.6% inflation to become embedded. I'm just going to look at the Fed probabilities here for November, which are pretty much unchanged, still at 41% for November, 7% for September. Carl, back to you.
Steve, really quick, just your thoughts on reports, the journals, the key example of the nature of the debate within the Fed changing a bit, perhaps?
Well, I mean, I think for sure that's what's been happening. I think that the Fed does not want to hike more, and the idea being the risk being more balanced, but they will hike. And this number kind of is part of that debate, Carl, the idea of having inflation expectations embedded perhaps at 3.5%. But if you look at the 3-year number, it's kind of going the right way, and that's going to ultimately determine probably where they end up. The ultimate question, I think, is what happens to that service number. We'll watch that carefully on Wednesday. But then you have that other journal story saying people still traveling like it's going out of style. Ask Sarah about that. She's very hip to the travel business and also personally, I think, as well. She's been on the road a bit. So I think that when that keeps going and those components of the service sector keep pushing, it's going to be hard to get that relief the Fed's looking for.
Okay, guys, and I hope you guys found and kind of paid attention to the fact that he was talking about how important it is to the Federal Reserve about inflation expectations. So I'm going to show you guys again the 5-year break-even inflation rate, which is expectations for inflation. The Federal Reserve does not want expectations of inflation to become unhinged. If that happens, the sentiment in the market gets wild, gets crazy. But I do feel like it's super incredible what's going on right now, because we have the tale of two cities in the market. We have all of these people saying inflation's gone, it's done, no more rate hikes, start cutting rates. And then we have this other part of the market that's like taking a flight to safety, that's going into treasuries. And look at this. This is the 5-year break-even inflation rate. This has gone up, not down since September. Almost every single day, the break-even inflation has gone up, except on Friday, it didn't go up. Interesting that this didn't update yet for Monday. Oh, there's Monday right there. Okay. So again, since September, this has only been going up. And more than likely what's going to happen, you guys, is when we get CPI out tomorrow, even though it's completely a waste of time and completely useless, in my opinion, of course, just my opinion, it's going to come in higher. CPI is going to come in higher, probably 100% result of shelter. That's my guess anyways. I think CPI is going to come in hot. I mean, how could they hide what's going on in the housing market anymore? You know, things are softening, but they're not softening as fast as many of us would like them to. Okay. Now we're going to listen to Danielle DiMartino Booth, super cool lady. She thinks that the Federal Reserve may be doing too much, actually. So very, very interesting, guys. She's saying that the economy is all messed up. It's just lagging and we can't see it yet. But there's like massive headwinds. So take a listen to her as well. And then we will get this show ended. Definitely appreciate y'all. If you can let me know that the audio is good, I would appreciate it. And all of the videos will be linked in my description as usual. Thank you guys so much.
QI Research CEO, Chief Strategist Danielle DiMartino Booth. You know, Danielle, Powell starting to get a little cocky here. How worried does that make you?
It makes me really worried, Charles, because I learned the rules of the road about the labor market and its strength when I was a rookie at the Federal Reserve. And the rule of thumb there was 3 months of revisions to non-farm payrolls up or down meant that you were at an inflection point. And we've had 7 months in a row now, Charles. Every single month this year that we've had payrolls reported, they've been downwardly revised. And indeed, fresh data out of the New York Fed this morning showed that Americans' perceptions of a weakening job market are at the worst in 2.5 years. Concerns about losing their jobs. So I actually think that the consumers are starting to get the message, and it appears that the Fed is tone deaf, even using its own rules.
You know, to that point, you've been talking about this, right? The soft underbelly of consumers. You know, we obviously had all that stimulus money, but we're going to these credit cards, even with the highest credit card rates ever out there. I'm reading more and more about this. Of course, we get retail sales this week. You know, but what do you make of the notion of that so many folks out there believe it's okay? Like, you know, even though you don't see where the cash is going to come from, that the consumer's not tapped out.
You know, it's kind of surreal, Charles, because and I see it on my Twitter feed of all places, and that's that, you know, the government's going to bail us out. We can spend more than we make. We can spend beyond our means. It's okay. Somebody's going to come and rescue me with a stimulus check. And that really is the post-pandemic mindset. And it's not the right way to think about your financial future, as you well know. I mean, part of financial security is learning how to save for the future, not spending more than you have. We had fresh consumer credit data out on Friday afternoon that showed that Americans barely took any money out for car loans, but boy, did they pile it right, another $10 billion right onto those credit cards. This is not the way to become financially secure. And I really do hope that many Americans' mindsets begin to shift. Yeah, well,
you know, I think to your point, a lot of people are probably just going to have to learn the hard way. I hate to say it. Oh. So where does that put us with respect to recession? You still believe it's inevitable?
Well, again, Charles, I go back to the sheer number of revisions 1 month after another. The St. Louis Fed is at negative 0.26 for the current quarter, whereas the Atlanta Fed's at 5.6 for GDP. You could drive a Mack truck through those two estimates. But as you know, when we get a lot of these data points reported, we're seeing constantly this was downwardly revised. And I'm not just talking about payrolls. And that's what we're seeing. We're seeing, and that's what you see when the economy is taking a turn. There's an undeniability, Charles, about there was another bankruptcy that was just announced today. A big retailer just went belly up this morning. And when you see bankruptcies rising at the fastest pace since 2010, that means that every bankruptcy is attached to people losing their incomes in their entirety. Forget about living beyond your means. How about not having any means at all? We cannot ignore the bankruptcy cycle as much as many on the street would prefer to do so.
So I got 30 seconds. Then would you be okay with the Fed just holding here, pausing and taking just pausing and again, being data dependent? Should they be hinting that, hey, that the task is done, mission accomplished?
I certainly don't think that they should stop shrinking their balance sheet. That was a failed experiment for them to monetize every penny of fiscal largesse that was done. But I do think it's time for the Fed to pause on the level of interest rates. I think that that's an appropriate stance right now, Charles.
Danielle, thank you very much. Always appreciate it. All right, folks, I want to bring it on.
All right, you guys. So, a couple things that I picked up from right there. Now, obviously, like I've been saying, the revisions of data. Okay, everyone's celebrating GDP, everyone's celebrating the labor markets, people are celebrating all these things, but to me, it's so foolish because the data's changed and they don't go back and say, oh, well, actually, the data keeps being changed. Literally, this is unprecedented because it's all in the same trajectory. It's worse than what it actually appears. So isn't that a trend, you guys? I mean, they're hiding how bad things really are. And did you guys catch that there's one Federal Reserve that's basically estimating that next GDP is going to come in at negative 2.6. And then another Federal Reserve thinks GDP is going to come in at 5.6 in the positive. These are our officials, you guys. How are they getting this so wrong? Crazy. I mean, this is 2023. I mean, there's AI now. How's this? I don't get it. I got a few more comments I'm going to pull up, guys. Now, just so you guys remember, and this is Dustin's comment, the last crash took 7 years, 5 years to bottom in 12. And so patience, it's more like a slow leak. And actually, Dustin, what's interesting is if we go back to just look at the Case-Shiller. So the Case-Shiller is a way to determine value. It's an algorithm used to determine value. It took 10 years to hit the peak. Again, go to Case-Shiller. It took 10 years to get back to the peak during the great financial collapse. Again, go to Case-Shiller, see that for yourself. But that actually took 10 years. Pretty crazy. Generally, is there a delay between Fed cutting rates and the new rates hitting loans? So the thing is the federal funds rate technically doesn't track or follow residential mortgage rates. The 10-year does. But generally, when the 10-year moves, so do mortgage rates. So like, for example, probably the lag on the 10-year, I don't know, 24 to 48 hours, depending on if it's a business day or not. So the 10-year affects mortgage rates very, very quickly, actually, very, very quickly, probably a day or two, depending on the lender, depending on how much loans they've already purchased at the lower rates, actually. Here's our last thing, guys. Look at the BLS jobs report. Every month, job growth numbers have been revised downward, exactly. Significantly, the following math. Most people aren't paying attention to anything but current month numbers. I'll argue, Matthew, there's some people that aren't paying attention to anything. So overall, guys, here's what I'm going to do with this information. You guys know I'm on the sideline. You guys know I'm renting. I have my down payment saved. I have no consumer debt. I'm qualified to buy a house right now. I'm literally looking every single day. I'm not waiting for the bottom of the market. I'm not trying to time the bottom of the market. Okay. I'm not a first-time home buyer. I'm seasoned and I'm still staying out. So what I'm going to do is I'm going to continue remaining hopeful. I'm going to continue remaining disciplined on my goals, increase my purchasing power. I'm going to save my money, make sure I'm out of debt. I'm going to improve my credit, and I'm going to keep watching and monitoring my market so I don't have to rely on people that don't know what they're talking about, like Redfin, Zillow, these economists. I want you guys to trust you, and that is the purpose. That's the primary purpose of these morning lives. You guys need to trust you because we know we can't trust corporate people, the greed, the drive for commission, putting food on the table. I mean, it's ugly. So I want you guys to remain cautious like me. And I'm going to be transparent about my journey. But other than that, guys, I just wanted to say I absolutely love you. I'll be back tomorrow. Look out for this evening's video. Love your family, love your life, and the most important thing, love yourself. And other than that, if you're out there investing in real estate, you guys know I wish you luck. Thank you for joining us today. And I hope each and every one of you